Hey, hello everybody. So today we will be analyzing the US mortgage rate data using Python. If I'm not familiar with the Python programming, that's still okay because I'll be using just basics of Python programming, and yeah, so nothing complicated, simple programming. Only the basics. So as you may know, the mortgage rate is now quite high, and it's been in news in the last few weeks. And the mortgage rate in the US has been increased to 6.2%, I guess, right? And that's quite a change actually. And it's not just in the US. In fact, it's happening all around the world, including in the Europe. And we will take the historical data for US mortgage for last many years. I found this beautiful website where I found this data. This is some economic research. This is Fred. So we've got the economic data here. You go to this website and you can get this data. I have downloaded it already. You can go to the download and just download in Excel or in CSV or in PDF. You can download the data. I've already downloaded it, and this is how the data looks like. The data is from 1971, so we've got mortgage rates from 1971 up until 2022, I think. So when is the last that? It's just 2 days back. So until 22 September 2022, we have this data. I think almost 50 years, right? So data for more than 50 years, and it's weekly data. This is weekly data. So we've got mortgage rate, average mortgage rate for each week, starting 1971, April 1971 until September 2022. So about 51 years of data. So it will be quite interesting to see actually how the mortgage rate in the US has changed over these years. And we'll use Python for that. We'll do some basic visualization using Python code, and we'll try to understand. There's some graphs already in this site, so you can also explore without having to write Python code, but I think it will be more fun if we use some code and you can manipulate using the code, and you will and that's a bit more fun. Okay, I was going through some of these news items on this, and it looks like the mortgage rate is going to go up even further. Actually, it's now 6.2%, 6.7%, right? Or it's 6.7% for 30-year fixed rate. It depends on what kind of mortgage we're talking about, whether it's a 15 years mortgage, whether it's a 30 years mortgage. So depending on the tenure of the mortgage, the rate is decided by the bank. And for 30 years, it's 30 years fixed rate. It's about 6.7% in the US. So that's a massive increase in the last few years. It used to be less than 4 at some point. In the Europe also, in Netherlands, in the UK, the mortgage rate has gone up quite drastically. It has more than doubled in these countries as well. But this is not the first time where we see such high mortgage rates. And we'll come to that. We'll see actually in the data that in the past also mortgage rate used to be 6%, 8%, even 10%, more than 10% in the US. Okay, so we will analyze that. We will see actually when was it, and maybe some we'll try to understand as to when that happened. At what point in time was there any economic scenario because of which this happened? How long the high mortgage rate was at that point in time when it was quite high? Because now economists are saying that it will sustain for some time, and that will cause a severe damage to the housing market. It will go through a correction. Now it is quite at the peak. The house prices at the peak, so it will go through the house prices will go through correction because of high interest rates, especially the houses in the higher end, because many people will not be able to afford buying houses with such high interest rate. And it's not just in the US, it's happening everywhere. So yeah, you can go to this mortgage news daily in order to understand, if in case you want to know what's going on. They have detailed analysis on each and every event happening with regards to mortgage rate in the US in particular, but also in other markets. And there also you have got data, so you can also download data from this. Okay, so for instance, this is a 1 year rate, how it has changed. It used to be 4% a year back, now it is 6.7%. so that's like about a 60-70% increase. If you look at the 5-year trend, it used to be about 5% 5 years back. And then if you take maximum, it will be very different. Then in ITs it will be quite high, as you see here, right? But we'll see. We'll go through some Python script, and we will plot these graphs ourselves using the data that we have downloaded. I have downloaded it already from this beautiful site. What is this called? Yeah, this one. Yeah, I was also going through some news item on Yahoo Finance on mortgage rate, which is, and it reports that the mortgage rate has rate rise for the 5th week, and it's time for home buyers to abandon their old assumptions. So especially for variable, the ones who have gone for variable rates, they will be struggling with paying a high mortgage actually. But the ones who actually went for the fixed rates in the US, I think they would be quite feeling happy, because they don't have to pay the higher interest because of the change in the mortgage rate. Yeah, and there is some analysis, about whether it's really high or not, and what it says that the average long-term rate on 30-year loan is 7.7%. So that's, if you take the historical average, it's 7.7. So it's still not quite high. It's quite higher relatively compared to a year back, but it's still not quite really high if you take the historical data into account. On average, it is about 7.75. Okay, so let's go to Python environment. I'm using Jupyter Notebook. You can also use it. It's very simple. You can just download Jupyter, Anaconda, and if you want the data, let me know. I can also share it with you, but you can also directly go and get the data from this website. I just shared with you the name of the website. First we will import the important libraries that will be used to analyze the data. Now this is time series data, right? This is the time series data, as I showed you. So time series data is nothing but data where the data points are based on different time periods. Okay, so this is a univariate time series data. That means there's just one variable, which is the 30-year mortgage rate in the US. So this is one variable, one column that we are interested in. The other one is just a time. It's a timestamp. At what point in time, what was the interest rate? So it's just a timestamp, the first variable, which is date, and mortgage rate in the US for 30-year tenure is what we are interested in. So it's univariate. That means it's just one variable, and we will analyze this particular time series variable. Okay, and this is time series data because this is collected. This has been collected at different point in time with equal intervals. So here you see it's a weekly data. It can be converted to monthly averages, quarterly, even yearly. Okay, that is very much doable actually, and we will see that also how this can be done. But you can convert that yourself also in Excel sheet also, and then take it to Python. But you can do it in Python also. You can convert the time series from a weekly time series to weekly mortgage rate to monthly mortgage rate or yearly mortgage rate. So that conversion is quite easy to do in Python, and you can do that. Okay, So this is typical time series analysis, and in time series analysis we'll need some of these packages, Python packages, in order to analyze time series data. For example, we will be needing matplotlib and seaborn for visualization. Will be the pandas in order to do some data manipulations. So this is my working directory where I've kept the data. So this is something I'll run. To run, just control and enter. You press it, it will run it. And then we'll first import the data to our Python environment. So this is the one. So here we have pandas as PD. So henceforward I'm not going to write pandas. The short form is PD, so I'm going to use that. Okay, not to confuse you with that. But if you're familiar with this is I think quite straightforward. So we get the data. Okay. So mortgage data, and the index here is the date, which is the left column, right? So we import it and store it in a data frame called mortgage. You can give any name. I've given mortgage for the sake of simplification. Okay, so let's run it. So using this, we have now imported the data. If it is running successfully, then there is no error. Otherwise, it will show us an error, right? But just to be sure that there is a data already, just write print mortgage.head just to see the first observations, and here you see the first observations already in the Python environment. Okay. Somebody's asking whether it's Anaconda available for Mac. Yes, of course. Anaconda is available on the Mac. Right, you can just let me show this you. Anaconda. You go to Anaconda site. You just go to download. Oh, it's just for the Windows, I think. So I don't have a Mac PC, so I don't know, but I think people use it for Mac. Yeah, so you also have, there's some website I think provide information on that how to install Anaconda on Mac OS. So I think it's possible, but I will not go into the details of it. I think there's some good ones. For example, on DataCamp, there's DataCamp website. You have this this article you can go through installing Anaconda on Mac OS. On DataCamp. DataCamp is a very good source for all data science related information. So you can just go and check this out. I'll put this one maybe in the chat, just in case you want to go through it. Okay. So thank you for asking this question, and please like the stream if in case you haven't liked it. That's the way you support the stream, and more people can then watch it. Okay, and if you have more questions, please feel free to ask me. All right, so where were we? So we imported the important libraries with pandas and matplotlib and seaborn, and the OS is just for setting up the working directory. And then we imported the data from, so my data was initially in my laptop in a local folder. I have now imported it. Okay, so this is the path of the folder where the data is there, and then I've just imported from there, and here you see the right. If you want to see the entire set, you can just print mortgage, but if you want to use head, you see only the top 5, right? And we don't want to see the entire set of data sets. It's no point. Just to be confirmed that the import is proper, you just write this part of the code, right? And you don't need to see all the observation, just see the top 5 one, and you can be sure about it. All right, so first thing we'll do is that we will try to plot it actually, right? For the entire 50 years, how does the mortgage rate look like? Okay, simple. Again, we are using a plot with a title of mortgage. You can give any title rate, for example, mortgage rate for the last 50 years. You can use any light, and then you have plt.plot. Plt means your matplotlib. Okay, so you're using matplotlib here. Matplot.pyplot as plt. That means from here onwards we're not going to use matplotlib.pyplot, rather we'll use plt. It's a short form, right? So that's the industry standard of using short form, so you can also use it. Okay, we'll run it, and here you go. You see the movement of the mortgage rate from 1971 until 2022. And what is interesting is that for much of the 70s or 80s and 90s, the mortgage rate was well above the 6%. So compared to what it used to be in the past, we're not in a period where we see a very high mortgage rate, because the mortgage rate was quite low actually in the last decade or so. We feel that okay, it has increased. It has increased quite dramatically, but that's not the case actually. It used to be even higher, much higher in fact. I think in the 80s it used to be around 18%. Imagine you have to pay 18% mortgage rate on your mortgage. I think that's insane. That's like 3 times than what we have currently, which is about 6%. So that is perhaps the worst case scenario in the last 50 years. 18% was the mortgage rate sometime in the early 1980s. But not just in 1980 where we said 18%. If you see in 70s also it was above 8%. In 90s also it was above or around 8%. In 2000 and 2010 it was still about 6.5% on average. You see here it was 6.5%. And in 2007 and 8 there was subprime crisis, but you still see that in 2008, 7 and 8 the mortgage rate was still around 6.5%, not more than that. So the housing crisis, the financial crisis did not quite affect the mortgage rate in the US. Okay, just to be clear, this is just US data. I'm not talking about data for other countries. It's just the US mortgage data. So yeah, in other countries it might have had a different kind of impact, but not in the US. You see, financial crisis didn't have much impact on the mortgage rate, and then it gradually actually decreased to about 4% until recently 2020, during the pandemic year, right? 4% or even 3.5%. That kind of mortgage rate was there in that in period, but it was gradually coming down, from having 18% mortgage rate in 1980s to just 4% in 2020, right? You see a downward slope here, right? You see a downward slope here. So that's the story here. People are complaining about it, but they do not know actually what used to be the mortgage rate in the past. And that's why some of the economists are saying on average, historically, if you look at 100 years, even more than that, in the US mortgage history, the average mortgage rate has been 7.5%. So we still aren't near to the average mortgage rate, right? So it's still on the lower side. Anyway, we will then plot a rolling mean. Okay, now for rolling mean is nothing but taking certain number of observations to calculate average and then using a plot, right? So this is just plotting each and every individual observations, right? This is weekly rate, by the way, right? If you average it for month or quarter, then it will look like a bit different, right? So the visual plot will look different if you change the frequency of the data, right? There are many ways you can do that. You can first calculate the mean or average and then do a simple plot like we have done, or what you can do is that you can roll it and then plot it, right? It will look very similar, but rolling is like a bit different. That means the same observations will be used in multiple data points, right? Because it's a rolling, right? It's more like moving average, right? You're averaging observations for certain number of periods, but it's moving. That means each observation may be counted multiple times in the average calculations. So I'm not going to get into the details of what is a rolling average, but you can read more about it on your Wikipedia also. There's a simple explanation of that. So here I've used the 12 period rolling average. Okay, and so you see the black spots actually. Okay, so no, not the black spot. I think the blue one is the rolling mean. The blue one is the rolling mean, and the black one is just the 30, the original data, which is the the weekly data, right? So 12 weeks, each 12 weeks is averaged out to 1. So here you see it's a bit smoother version of it actually, right? You see here it's less smooth, but here it's you can also change it to, let's say 120 also. That should be fine. Let's see that. How does it look like? Okay, even 120 is fine, I think. 120, but I think we can also take a 60 maybe. Okay, you can change it and see how it looks like different. Okay, but we can also plot the histogram, right? It's a different way of visualizing the same data. It's and the reason why we're doing it the same, but it's just that it gives a different type of picture, so you probably can make something different out of it. Okay, so just see that like it shows the frequency, right? How many times the interest rate, mortgage rate was 4%, how many times for 6%, 8%, 10%, 18%, 18% or above 10%. You see that the bars are very low. That means only very few years in the last 50-60 years when we saw a mortgage rate above 10%. So you see the bars here for 10%, 12%, 14%, 16%, 18%. That's quite low. But it has happened. Higher interest mortgage rate above 10%, was there in the history. But most of the times, the mortgage rate is was between 6 to 10%. You see here, 6% and 8%, 10%, right? The bars are the highest one, right? So mortgage rate has always been between 6 to 10%, mostly, and in few occasions more than 10%. But also quite some periods, the mortgage rate was between 2.5% to 6%. Interesting, when was it when the mortgage rate was 2.5%? It's also interesting to know. But yeah, there were times when mortgage rate was about maybe 3 and 3.5%. Maybe in 2019 also it was 3.5%, if I'm not wrong. Right. You can plot something called kernel density. It's a bit smoother version of it. It's the same plot, histogram, but it's a bit smoother version of it. So here you go. So this is the kernel density 1. Right. If you're writing an article, you will rather use a kernel density 1 than this particular one. It's easier to look at it. It's easier to interpret it, and looks better also, right? But it's more or less the same. The histogram and the kernel density points. The tail, is pretty similar. We can also have box plots. Yep. So box plot will tell you the median mortgage rate in the last 50 years for this data. Okay, so box plot gives us the median and the extreme values of f time series or for any data, any distribution. And here you see the median is somewhere around 6.5% or 7% maybe, because this is 6 and this is 8, so in between it, right? So it's 7%. So basically, so in this article where it, I think they have quoted some economists saying that, it's 7.76%. I think some economist, vice president of TransUnion, has given this remark that it's 7.76%. The average it's supported by the data, right? You see here, it's about 7.5%. The median value, right? Mean would be slightly different than median, but then I think it shouldn't be very, very different. And then you have the 25th percentile and the 75th percentile, right? And you also have some outliers like above 16%. You can consider them as outlier. We can also do a differencing and plot it. That's also possible, but it's not very useful in this kind of thing, I would say. But okay, we can indeed. Maybe let's try this. The differencing is about taking a difference of the consecutive mortgage rates. It doesn't tell you much actually, but okay, let's try this still. Okay, something like this. Okay, I'm just doing a shortcut. Okay. Okay, I'm missing a syntax issue. What am I doing? Really? Oh, sorry. Yep. Yeah. So first we did a differencing, first order differencing. That means it's just it's like x2 minus x1. That means x2 is the, let's say, mortgage rate of the next period, and x1 is the mortgage for this period, and you take a difference and you do that for each consecutive periods and do a plot. And yeah, so what do you get out of it? Yeah, you just want to know whether there are outliers and things like that. But it's not very useful. So let's not spend too much of time. But this is also an important analysis in time series assessment. Maybe in other kinds of time series like stock price and all, or maybe if we want to forecast the mortgage rate using historical time series data, then this is useful. So if you want to do some sophisticated time series modeling, yes, this is useful. Otherwise, it's not very useful. Okay, so our data is weekly. We can convert that to monthly data also, which is is about taking an average of the weekly mortgage rate and converting that into a monthly mortgage rate. Right? We can do that. We can do that ourselves using an Excel formula, creating a new column in the in the Excel sheet that we have used to import the data. But you can do it here also, right? You just use series sample. I'm using M here. M means monthly data. So we have the weekly data here, right? You can convert that to monthly data using this and using mean, but you can also use other way of summarizing it using median or standard median. You can use a mode even. Okay, so that's done. Let's plot it. Lot of syntax mistakes. Yes, I've given it a different name, right? And then we use this new data where we have data in where the frequency is monthly instead of weekly. Initially we use the weekly data, but this is monthly data. We converted that and then we plotted. It looks pretty similar to the weekly data, doesn't change much. And so what it says is that in the short term the mortgage rate hasn't changed a lot, but over a longer period of time it has changed a lot, right? So imagine in 80s, right? It started sometime in 80s, and where the mortgage rate increased above 10%. It happened sometime in early 80s or 80s, and it continued until 90. So it took a full decade. It stayed for a full decade, a full 10 years, right? So if the mortgage rate goes up, it remained there for a long period of time. And when I said a long period of time, it is about 10 years. So that's what we see in the data. Okay, and when it goes down, it also stays for a decade time. So that's what you see here. In 2010, the mortgage rate was 6%, and in 2020 it was about 5-6%, or about 4%. So the low mortgage rate continued for a decade also. Okay, so you don't see a mortgage rate where a couple of months back it was 5% and now it is 9%. Right? Maybe in crisis situation this might happen. This might happen in crisis times when there is some economic crisis going on, recession is going on, or there is a correction that's happening, which is what is happening right now in the US or in much of the world, where we see a correction happening in the housing market, where we see the interest rate is going up because the central banks are increasing the interest rates, because of which the mortgage rate is also increasing, because mortgage rate is tied to the central bank interest rate, and central bank is doing that to deal with the inflation rate, high inflation rate, and we're having one of the highest inflation in the last 40 years, right? From 80s. The last time we had this kind of high inflation rate was back in 1979 in the US, but also in Europe and elsewhere in the world. So these things are all quite related. Okay, all right. So one other thing we will see, which is about coefficient of variation. Okay, so it's about how it is varying or not, right? Again, for this particular data it may not be very useful, but in other time series analysis you can use this. But this is also a good number to tell you. If it is about anything above 1, then it shows that it's varying a lot. Otherwise it's fine. I think it turns out to be, I think it's 42%, which is fine. But it's above 100%, I think it is a problem. I think it's even bigger problem. It is above 150%. That means it is quite steady. That means it's not varying a lot. If it is high, it is remaining high for some time. If it is low, it is also remaining low for some time. So there's not a lot of variation there. But that is not going to be the case, for example, in some of the stocks. If you analyze Tesla stock or Amazon stock price, then you probably will see the variation is quite high. So this is quite useful actually in stock market analysis, stock index analysis. If you are doing time series analysis on stock price data, on bond price data, and you want to know the volatility of a given stock. So this particular thing is very useful. So coefficient of variation is quite useful then. Okay. There are other things also you can do. For example, you can plot the ACF and PSF. If you are familiar with ACF, autocorrelation function, partial autocorrelation function in time series analysis, you can also plot them. You can get to understand the correlation between the past with the present. But unless we are building models, like we are forecasting mortgage rate here, we are building models for forecasting, I think we do not need to plot ACF, PSF, but you can try that. Okay. So okay, all right. So it's quite fun actually doing this analysis. If you want the data and if you want the Python code, let me know. I can share it with you. And if you are a home buyer, all the best. I myself is exploring to buy a house, but because of the high mortgage rate, I'm not quite sure if this is the right time. But I will wait. I'm just thinking that maybe if I wait, then the house prices will, I can get a better deal in the future. House price, mortgage rates, US.
When you take the world's biggest brands and add them to the world's best zero-commission broker, you get infinite trading opportunities.
At an open house in Phoenix over the weekend,
Should we do a dilution or should we, buy?
potential buyers were nervous.
The interest rate thing is, a little tough.
Tough because not only do sharply higher mortgage rates make already pricey homes even pricier,
Would this be a good house for hide and seek?
but for current homeowners looking to move up,
One of the challenges for us is that we currently have an interest rate of 2.875%. And so the idea of getting a bigger house and more than doubling our current interest rates is not particularly appealing.
that's the main reason home sales are slowing down so quickly. Sellers are no longer in the driver's seat, so buyers who had no bargaining power during the red-hot housing market suddenly do.
They are therefore asking for incentives so they can help buy their rate down. And they're asking the sellers for that incentive on top of their offer they're making.
And prices are finally coming down.
The washer and dryer is brand new.
They normally fall just from June to August because families buy bigger, more expensive homes in the spring so they don't have to move during school. But this year, the drop was 3 times what it usually is.
I have seen the prices come down a little bit, so that's nice, but it's frustrating, I'm sure, for a lot of people.
For those who still can't afford it, and even for those who can.
And this is something we could afford, but it makes tremendously poor business sense in this environment.
And mortgage rates actually fell.
Let's talk about that now. Joining us to discuss is First American's Deputy Chief Economist, Odetta Cushy. Good to see you, Odetta, as we look at these numbers. Interesting that we didn't see more of a drop, but just sort of high level, how would you describe the state of the housing market right now?
Well, it's great to be here. So there's a demand and a supply side to this story. Clearly on the demand side, buyers have pulled back from the market as affordability has quickly deteriorated and mortgage rates have hit above 6%. On the supply side, you can't buy what's not for sale, and sellers are sitting tight right now because they're locked into these historically low mortgage rates and they don't have a financial incentive to move. And so we're finding that sellers aren't selling, buyers have pulled back, and that's resulting in a housing market that's cooling quite a bit.
And on the other side here, I guess holistically I should say, you've got home buyers or prospective home buyers who are still looking for where they could find inventory, where they can find a home that they can compete with on an offer. And if they're not able to do so, that they're staying in the rental space. Redfin actually had just reported asking rents climbing 11% in August, and even though that is the smallest gain in a year, it still does go to show that you've got some prospective home buyers that are still impacting the rental market, and the renters out there that are still having to take on the burden of some of the higher prices.
Right, so renters have a tough decision. If they're interested in buying, affordability is down, and to your point, inventory, particularly at that starter home price range, is still incredibly limited. We're still facing historically low levels of inventory in a housing market that's underbuilt. And so they're facing higher rents and higher home prices, reduced affordability as well. So they're certainly in a tough spot. We are seeing rent growth start to decelerate. Similarly, house price growth is decelerating as well. So that's some welcome news for those potential home buyers.
You know, like so many other things that we saw during the pandemic, Odetta, it feels like that this is a rebalancing to a more quote-unquote normal level, perhaps, but I don't know what normal looks like anymore. How long do you think this process is going to last? And to you, what does a normal, what does a normal median home price look like? What does a normal existing home sales pace look like?
It's a great question. So, double-digit annual house price growth is not sustainable. So the market of the last 2 years is the exception, not the rule. It was incredibly hot seller's market. You could argue we're still in a seller's market across many top markets across the country, certainly not as competitive as it was early in the year or last year, but still very much in a seller's market. I think you'll start to see house price deceleration to more reasonable pace. Historically, it's been about 4 to 5%. Mortgage rates are actually, believe it or not, right in line with historical average, if not a little bit below. So the housing market just needs to adjust to this not so new normal of higher mortgage rates, slightly slow. Lower sales pace and more moderate house price growth.
Is it possible to make $500 per day trading the currency market?
There was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. That's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
Fed Chair Jerome Powell, a renewed emphasis on housing and the real estate environment today at the Fed meeting after raising rates for 75 basis points, also saying that there was weakened significantly is how he described housing in this environment, the one area they're seeing evidence of success beyond all else. Let's talk about that with Danielle Hill, Realtor.com chief economist, in terms of where we're headed. Danielle, your reaction to that statement from Powell about a correction, are you seeing compelling evidence that we are in correction territory? Is that still down the road?
We've certainly seen sales activity pull back significantly. Today's numbers on existing home sales were down almost 20% compared to a year ago. That's the second month in a row where the decline's been about that large. We know that the housing market was overheated at this time last year in response to very close to record low rates. We are seeing now that buyers are responding as rates climb to new records. Home sales are pulling back and we're seeing fewer transactions in the market.
Danielle, when you take a look at the potential correction here, I guess how much worse do you see it potentially getting here for housing in the next couple of months?
I think that remains to be seen. A lot depends on what happens to mortgage rates. We know that housing is a very interest rate sensitive sector. The difference between 5% where we were, just 6 weeks ago and over 6% now is a pretty big payment shock. And if you look at where we are now compared to where we were 1 year ago, monthly mortgage payments are up 66% between the combo of higher mortgage rates and higher home prices. So that's a lot for households that are shopping to absorb. I think as long as we see mortgage rates remain elevated, it's